welcome back to my YouTube channel. Today in this video we are going to discuss about the overall business process of KYC AML. As I mentioned, this is overall business process. This video is only meant for beginners and people with 1 year or 2 years of experience. And those are like freshers, like graduates and postgraduates, those who want to shift into KYC. This video will be overview of it, how it is going to be and what it is like to be, so that it will be helpful for you to take decision whether you want to choose the KYC field or not. And this was includes like very lot of topics because I will cover the entire business process. Some topics you might have already know, you can skip that part. As beginners and those who are like freshly, those who don't know about anything about KYC and AML, this will help you to guide to some extent. And as I mentioned, this is the overall business process. It is going to be very lengthy and it will be going to very interesting, because if you know the entire story, if any part of the question is asked in the interview, you can able to answer it, or at least you can able to try to explain that what you know in the interview. So without getting further delay, we'll get into the video. So before we know about the overall business process, first we'll start from the perspective of a business person or an entrepreneur. Because that's where, if you understand, if you want to know understand any business process, you have to understand from the perspective of who started that business. It be a board of directors or CEO or a founder or an entrepreneur or a businessman. Okay, the main purpose of any business is to earn profits. Let it be banking, non-banking, NBFC, IBFC. So whatsoever, the main purpose of any banking, any business is to earn profits. In the same way as we are working for the banking profile or banking business, banking industry, the main purpose of our banking is also to earn profits. But how do the banks get profits? There are two ways how banks earn profit. One is from the deposits the customers deposited in their banks, and the other one is because all the deposits will be stored somewhere in the bank. So with the excess cash, the bank gives loans to few customers and they earn interest with their, that is the one way of profit making. The other one is from the treasury department. The treasury department of the bank takes over the excess cash left over and try to invest in mutual funds or maybe gold bonds, ETFs, and bond deals. And there are some other financial instruments which bank will be investing in it, and from the returns the bank earn profits. These are the two ways the banks earn profits. As we mention, or we as we always mention, the main purpose of any business or the main purpose of banking business is just to earn profits. When we say profit, there is a risk. There is also a risk in it. So when we say where there is a risk, there is a reward, and where there is a reward, there is a risk. So our main aim of business is to earn profit. So there is a risk in it. So now, what are the risks that associated with the banking business? So there are mainly three types of risk. The first risk is like fraud or insolvency petition. For example, the bank has given a loan to a person, and the person, he paid only half, and rest of the half he made himself as a insolvent, which means he is not able to pay the loan. Which means he went to the court and he filed an insolvent petition and he won it, and the bank has no right to touch his personal assets or anything that is left over, because he has become insolvent. So that will be a loss to the bank. So that is if it is lost to the bank, that is a risk to the bank. And the other one is you have given accounts, if you have given a credit cards, if you have given a savings account to few customers, and those customers have been involved with some online fraud, and they lost their funds from their credit card. This is very common, we have seen in the many previous situations. So this one is a fraud and one is like insolvent customers being insolvent. So these two risks are handled by the department called fraud department. That's what we say, a fraud department, or maybe a risk analyst, or maybe fraud analyst. These are the department that handles about these type of situations or this type of risk. So the next comes under the money laundering. Because if you want to launder the money, this is a basic principle, you have to understand it. If you want to launder the money, you need a bank account. It is very simple. So who gives the bank account? The bank will give the bank account. So there is already a risk in it. So, but how do banks prevent it? Like which department will take care about the money laundering stuff? We'll connect everything in the upcoming slides. I just giving you a brief how it is going to be. First, you need to understand the main purpose of starting a business, and if the main purpose of starting a business is to earn money or is to make profit, there is a reward, and which means there are risk is also in it. So now we need to analyze what are the risks we have. One is a fraud risk, so which will be handled by the fraud department, and that comes under the designations like fraud analyst or risk analyst, all those stuff. And next one is a money laundering, and money laundering is being handled by transaction monitoring department. And third risk is terrorist financing. Terrorist financing is one of the main risk in recent times. But how do we see that? How do we overcome that risk? By doing sanctions and sanction screening. So now we got to know there are three risks, and three departments we have. One is fraud, which will be handled by the fraud department. The other one is transaction monitoring, which will be handled by the transaction. One is second one is money laundering, which is handled by the transaction monitoring department, and third one is terrorist financing, which will be handled by the sanctions and sanction screening department. So these are the three types of risk. These three types of risk will be handled by the three types of department. Now you got a clear picture like what is transaction monitoring, what is sanction screening, and what is KYC. And when KYC comes into picture, because if you want to launder the money, because you need a bank account. But who gives a bank account? Bank. When the bank will give the bank account after performing your KYC checks. So their process, I mean, you have got an idea about the business process and what are the departments involved, what is the risk and what is the profit. So now we'll go and check with the each and every department. Before we learn about each and every department, first we have to look into KYC, because that is the way starting of the process which we need. For example, let's stay with the same risks we have. For example, if someone want to do a fraud or someone want to file insolvency petition, first he needs a bank account. When you get to being when fraud takes place, when you have money, then where will you store that money? In the bank. So which means you need a bank account. So which means they have to perform KYC. In the same way for money laundering also, if you want to do a money laundering, you need a bank account. Who gives that bank account? Bank. So bank already knows that there is a risk. So before giving the bank account, they have to perform some checks, which is called KYC checks. In the same way for terrorist financing, if you want to fund terrorist financing, if you want to fund terrorist, if you want to fund terrorist organizations, you need a bank account. And who gives that bank account? The bank will give. So as there is a risk in it, they'll screen before they give bank account to you. So the screening process is called KYC. And you know about KYC, there are few steps in KYC. Depends upon the risk rating, depends upon the risk appetite of the bank, and we have certain process which you might already know. I'll give a brief about it. And now you know about why KYC is done to prevent all these things. And there is one slight logic you have to catch here. Mm, I know the risk because I have to make profit. I know the risk, and how do I get, for example, money is being laundered from my bank account, which the bank has given me. How does that affect the profits of the bank? Because my main purpose is to make profit. I have given a bank account to a customer, and he is laundering money. But how does that affect as a bank to me? Why do I have to keep on check whether he is doing money laundering or not? Why I have to invest my money, recruit people, recruit resources, and train them and ask them to conduct a transaction monitoring? These are like very cost effective to me. I'm putting more expenses. If I don't put these expenses, I'll get more profits, but still I'm doing it. Wait, what is the purpose? He can launder the money. I don't have any issues with it because I'm making profit. But why do I'm putting extra money and extra investment, extra time recruiting people, training them, and asking them to check on his accounts, keep monitoring? Why I mean the bank is doing all this because if they don't do, the regulators will fine them. If the regulators are fined, they have to pay that fine from the profits they have. So there the profits are getting reduced. So If the profits are getting reduced, there is no point of doing business. So in order to avoid fines and in order to increase their profits, the banks invest some amount, and they conduct the recruit human resource or all these people, analysts. They train them and they ask them to monitor the accounts. That is the main purpose, that is the logic you have to catch, because no one is doing for charity here. I love my country, so I'll prevent transaction monitoring. I love my country, so I will go and stop terrorist financing. No businessman will do that. They are only doing, if they don't do, the regulators will find them. That is the only reason why banks are performing KYC checks. Now you understand, right? And there is one more call. So okay, regulators levied a fine to me, and I will be paying from my profits. Somewhere my profits are very good, so I'll be paying some from the profits. My profits get reduced. But on the other hand, they are losing their business. For example, once a bank is being penalized by a regulators, it will be all over the news. Every headlines that bank will be there. Every headlines that bank will be there. And if the bank name is on headlines, they will lose their goodwill. If they lose their goodwill, no new customers will be onboarded, because the goodwill of the bank is lost. If you new customers, they won't be onboarded. New customers won't be looking into that bank, and old customer also will get panicked. Okay, there is this bank is not trustworthy because the regulators find penalize that bank, and there is some fraud is going on in that bank. So the old customers will withdraw their funds. You might have seen this case in the S Bank situation. When S Bank was almost the share price got down, and because of lot of issues with the insider business and insider trading and all, we have seen many people standing outside of S Bank ATMs. There is a very long queue. They are withdrawing their funds. In the same way happens to the bank also. If once the bank is being uh, penalty levied on the bank by regulators, so they will lose the goodwill. So new customers won't be onboarded, and the existing customers won't feel safe of their deposits. They withdraw the deposits. If no new customers are onboarded and old customers are leaving, they don't have their business. If there is no business, there is no profits. So, but the main aim of business is to make profits. But if there are no profits, there won't be any business. So that is the reason bank invest a lot of money to recruit people and to perform these KYC checks or AML checks or sanction screening and all the stuff. Now you understand it, the main purpose, because when you understand the purpose, it will be very easy for you when you started working on a process. Now you know about, like, by the main how profits have been earned by the bank, and how to safeguard the profits, and to safeguard the profits what they have to do and what are the departments are responsible for it. Now we'll go through a basic version of this, and if you need any more clarity on this, there is a dedicated video what is KYC, what is CDD, and what is EDD. It is only a business process, so I won't be going in depth in the definitions, but I'll give you a very solid examples which you can remember and you can replicate in the interview. So talk about KYC. KYC is done before onboarding a client, and KYC, CDD, EDD. KYC is simple, but the first main step in order to perform KYC, we need some information which we will be gathering from the customer through application form. And CDD is nothing but, as I mentioned, there is a risk involved in it. So how do we know risk? How do we calculate the risk? By performing CDD. So it clearly mentioned, you need to highlight the word evaluate the risk. Here they mentioned evaluate the risk associated with the client. Evaluate the risk. So in CDD, we identify the risk of a customer, and in CDD, if the customer risk is identified as a high risk, then the case will move to ED. We perform enhanced due diligence. So in enhanced due diligence, we collect some documents like source of funds, source of wealth, and attested document from the bank's ombudsman person or a money laundering officer. So there's some other stuff which we collect from the customer in case we are performing a enhanced due diligence. As we heard about the word source of funds and source of wealth, so the next question interview will expects about, tell me the difference between source of funds and source of wealth. This is a very 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 common question which you can expect in any KYC interview, because definitely they'll ask you about what do you know about KYC. When you start speaking about KYC, CDD, EDD, in EDD you will definitely tell, okay, EDD is performed on high risk customers where we collect source of funds and source of wealth. then definitely the next question will be, okay, what is the difference between source of funds and source of wealth? Here the definition is not important. If you can tell, if you are very clear confident about the definition, you can tell the definition of source of fund and source of wealth. Here in KYC or AML, the most important is the number of examples you give. So source of funds is nothing but specific origin of funds. The word specific is important here. Source of funds is nothing but specific origin of funds. For example, salary income. And I own a house, I'll get rental income. This is very specific. I can tell this I got this income from my rent. I got this income from my salary. This specific origin of funds is called source of funds. And source of wealth is nothing but overall origin of funds. As I mentioned, overall origin of funds. Overall origin of funds nothing but it is a overall. You cannot specify. Okay, I got from this. I got from this. You cannot specify. It is the overall origin of funds. For example, you own a house. You are getting a monthly rent. That is called source of funds. But you sold the house. Now you get a very bulk amount, and that bulk amount is called overall wealth. When you sold a house, you will get a amount that is called source of wealth. But if you are receiving monthly rental income, it is called source of funds. And one more example, which can you can explain in the interview, or interviewer will be expecting these sort of examples. You have a equity, and for every quarterly or 6 months or maybe 1 year, you will get a dividend. That dividend is called source of funds, because you can specify, I got dividend from these stocks. I am holding like 200 shares. Out of 200 shares, 1 rupee dividend, so I got 2000. So you can specifically mention it. That is called source of funds. But after 3 years or 4 years, you sold your entire portfolio and you got a lump sum amount. That is called source of wealth. So that is the main difference between the source of funds and source of wealth. Next, as we mentioned about risk, so we need to identify about the risk. KYC you already know, and now evaluate the risk. I'll tell you very brief, because for each and every topic there is a dedicated video on it, so you can go and check it out. And this video is going to be very lengthy. Just pay a little attention, but it's worth watching everything, because you'll get a clear picture of what is what. And risk assessment of a customer. So there are four factors how risk assessment of a customer is valued. These are the four factors: nature of profile or nature of business, jurisdiction, product or service, transaction. And if you know how risk is calculated by nowadays, risk is mostly calculated by the system, because based on these four factors, because in the application form, nature of profile or nature of business, we will mention it. Jurisdiction, where is located, where the business is located, we will mention it. Product or service, in which product is opting for, savings account, loan account, or maybe credit card, we'll be mentioning it. Transactions also, we'll mention it. Transactions is nothing but expected transaction. The system will calculate expected transaction based on the nature. So by considering all these factors, the system will give a rating. See, 80%, 90%, 100%. So based on this rating, the risk will be calculated as a low risk or medium risk or high risk. It is usually 0 to 80% of a risk, low risk. 80 to 90, medium risk. 90 and above, it is high risk. Now we know the risk of a. Now we'll move to periodic review. So as I mentioned, for example, if the risk rating of a customer is low risk, we have to conduct KYC for every 5 years, which means we have to repeat the process for every 5 years. Medium risk every 3 years, high risk every 1 year. We have to repeat the process. Which process? The KYC process. We have to repeat it. This is called periodic review. Many people get confused with the periodic review and event trigger review. Those two are completely different. Periodic review is nothing but based on the risk appetite of the customer. We repeat the process of KYC once in 5 years or 3 years or once in 1 year. But event trigger review, whenever the event is triggered. I'll tell you an example. For example, I have given an account to a student. He came and approached the bank asking for, I am getting a scholarship, I need a bank account. So we have done KYC checks and we are given a bank account. But do you think that this person, he becomes a student to his entire life? No, right? After 3 years he will become a salaried employee, or maybe after 3 years he can start his own startup, then he will become an entrepreneur. Which means the risk is changed. When we are given an account, his risk in nature of business and nature of properly student. But after 3 years, his risk got changed to salaried employee, which means there is a change in these four factors. which means there is change in any of these four factors or any one of these four factor is changing, that gives a event trigger, which means that triggers an event, which means it states that there is a change in any one of the four risk factors. So again we have to do KYC on it based on the risk appetite of the customer, because the risk is changed. For student the risk rating is some percentage, but when he became a salaried employee or when he became an entrepreneur, the risk rating is changed. So then again we have to perform the KYC. So that is the main difference between the periodic review and event trigger review. So now we got to know KYC, we know how to find the risk, and we assessed the, we also know periodic review, and we also know the event trigger review. Now we'll see about, before we onboarding we have done all the checks, and we make sure that the customer is like okay, his risk is assessed. But before even onboarding we need to perform PEP, adverse media and sanction screening, because we have already seen we don't want to take the risk of by onboarding a PEP or onboarding a person with adverse media or sanctions. There is a catch here, just pay attention. A banking client, banking performs screening before they onboard a client. They perform PEP, adverse media and sanctions. If any person is free from these three, they'll onboard it. For suppose a customer is a PEP, you identified he is a PEP, but he is not adverse media, he is sanctions. But do we still onboard? Yes, the answer is yes, we still onboard it, because PEPs are the politically exposed person. They might have very long, very large amount, and if we lose that customer we might lose more commission on that. So we don't want to take that risk, so we all onboard the client. At the same time we'll keep a high priority or a high monitoring on that customer, because at the same time we don't want to miss the client. At the same time we don't want to take the we don't want to lose that return, so we'll take that risk based on the risk appetite of the bank, and we'll keep a close monitoring on PEP customers. We'll onboard them even with the adverse media also. If a person is a PEP and if a person is adverse media, based on senior management approval, we'll onboard these two people based on the risk appetite to the extent that the bank can bear the risk. But if the person is sanctions, we won't onboard any sanctioned individual or sanctioned entity or sanctioned vessel. We don't onboard it, because that is strict no for sanctions. So that is the catch here, because these are tricky questions, they can be asked in the interview if you are going for any higher level position. That's they feel that that's the basic to understand these things. So we can onboard a PEP, we can onboard a adverse media, but we cannot onboard a sanctioned person. Management, there are two types of questions they ask. What are the four pillars of KYC or customer lifecycle management? They both are same. There's nothing different between the four pillars of KYC and customer lifecycle management. They both are same. That's what, when you know about the entire process, you can connect each and everything. Because some people they'll ask about what do you know about client cycle management or CLM. Maybe mainly Deutsche Bank in Bangalore, they hire for this process CLM. They call it as a CLM, client life cycle management. And some they call it as a four pillars of the KYC. So it is almost the same. The four pillars of the KYC and the client life cycle management are one and the same. Now we'll discuss about client life cycle management. When we say life cycle, it is nothing but the life of a customer in a bank. When we say life of a customer, it is called the entry and exit of a customer. So the management that speaks about the entry and exit of a customer is called client life cycle management. So what are the departments, or what are the process involved in it? The first one is CIP, customer identification program. Why I gave CIP? I could have written customer identification program, but I wanted to write it as CIP, customer identification program. And if you observe very closely, customer identification program, where do we identify the customer, in which process? We identify the customer in KYC process. How? By collecting the documents. So that the reason CIP is also known as KYC, customer identification program. We identify the customer in this program based on the documents he submitted. We identify me as a male or a female, or is an Asian, or is an American. So based on his documents he provide, we identify the customer. So that is called customer identification program, which can be done in the KYC. Second one is risk assessment. And in which stage we will do risk assessment? we will do it in the CDD stage, client due diligence, based on the four risk factors. So risk assessment is nothing but CDD, client due diligence. And third one is CAP, customer acceptance program or policy. So this program or policy tells about on what basis, on what risk we can accept the customer. And ODD, ongoing due diligence. When you do ongoing due diligence in periodic review is nothing but we keep the same process again and then we do the process remain the ongoing for every 3 years, for every 2 years, for every 1 year. It depends upon the risk. Just called ongoing due diligence. So these four are called the four pillars of KYC or customer lifecycle management, like whatever you can call it. So these four are nothing but KYC, CDD, and ODD is nothing but ongoing due diligence, which is called periodic review. So these four factors are called four pillars of KYC, or these are also part of the customer lifecycle management. And last comes on the exit, voluntary or forcible. Sometimes the customer feels that other bank is giving more interest, he may choose to voluntarily exit from the bank. And the other one is forcible. For example, while conducting an ongoing due diligence, for example, he came to bank as a student and after he became a salaried employee. Once he became a salaried employee, we found that he is laundering money through his salary account. He is mixing up some all the transactions, like he's doing smurfing, structuring, micro structuring, and we found out that he is laundering money through salary account. So what we have to do, we have to exit him from the bank, voluntarily exit him from, forcibly exit from the bank. So that comes under the forcible exit. This is called customer lifecycle management. The entry and exit of a customer tells about customer lifecycle management. So here comes the one more case study. Just go through it, and I'll explain in very. This is like a very common case study. The So it is not nothing. It is very simple. It is a PEP customers. As I mentioned you, we can onboard a PEP customer, but we have to keep an eye on them. But this bank has failed to do proper conduct EDD perform on PEPs. So even the regulator is caught and they levied a fine. So if you see here, the main during the relevant period, Standard Bank had a business relationship with 5,339 corporate customers, of which 282 were linked to one or more PEPs. The bank had previously identified the shortcomings in this inability to continually monitor these accounts, but they failed to take adequate steps to resolve the issue. So they identified the PEPs, but they didn't do proper checks. Like they should be keep on monitoring the PEPs, but they failed to do that. As a result, the FCA, Financial Conduct Authority, the regulators of banks of UK, indicate the Standard Bank was unable to consistently perform adequate EDD measures prior to establishing new account with entities who had connections with the PEP. So here this is the main, unable to consistently perform adequate EDD measures. As I mentioned in the previous slides, PEPs we need to perform EDD. That has to be consistently monitor them, because we don't want to lose the PEP clients. At the same time, we don't want to take the risk. We have to perform the KYC checks from here and then, but the bank has failed to do that. So that's the reason the bank, the regulators caught them, and they filed the levied a penalty. It's all about 7.64 millions, and these they'll be paying this fine from their profits only. If the profits are getting reduced, they reduce the budget of the process. When the budget of the process reduced, our hikes will be reduced, our promotions will be reduced, our bonus will be reduced. So it is indirectly impacting each and every individual who is working for the team. Overall business process of KYC AML. And if you do still have questions, you can just drop down in the comment section. I'll be able to do a full length video on that. And if you have any specific questions, if you want to know anything in specific, you can just drop down in the comment section. I'll be happy to reply it. And there is one thing I just want to speak on that, because many people are asking me to do video on trust, to do video on SPV, to do a video on charity, or to do a video on fraud analyst, or to do a video on chargeback, to do a video on loans. See, I work for KYC, so see, you should also be in that position to think and understand whether whatever this person is saying, let it be me or anything, anyone, that how far we can trust this person. Because it is very common logic. I know it is very easy to comment down and write, please explain about loan, please explain about chargeback, please explain about fraud. But I'm not working in that department. See, in a year, if you take a complete year also, you cannot work on multiples of processes in a year. So even if I like learn from others, and if you put that in video also, that doesn't look good. Because unless and until I have complete knowledge, when I get complete knowledge, if I worked on that process, but it is a very simple basic logic or basic common sense that one person cannot work on multiples of processes in a span of the 6 months or 1 year. So first you just think, okay, is like, if we are asking these questions, and if I make a video, that doesn't look good, because I don't know, I don't actually know, not aware about how fraud works, how chargeback works. I am mostly into KYC and AML stuff, so I have these experience of client onboarding, end-to-end KYC, periodic review, sanctions, and transaction monitoring. I'm able to make more videos on that. But if you ask me about, you should also be in that position before you comment. Okay, if I ask this person, if this person is going to give me a genuine information or not, because you cannot trust someone so blindly and put it in a comment, ask him to make a video. If I make a video, I can gather some Google stuff information and put it on a story, I can put it on a video. But there are many people watching that video, and they should not be in that misconception, okay, this information is true. So before you check on anything, or check on any video, or listen to any information on social media, you should be in a position to understand, is this information genuine or not, like what is authentication of this information. So that is a very very important, because now the information is more, the authentication is very less. So you should be in a position to understand, okay, like, for the correct problem you should reach to the correct person. And if you are like, if you are facing some heart trouble, and if you go to a gynecologist, your problem won't be cured. So in the same way, if you put like I have seen a lot of comments like asking to do a video on loans, SPV, charity, trust, and fraud, chargeback. No, I don't think anyone can have all this knowledge even after having 10 years or 20 years of experience, because my domain is very limited. It was very straight: KYC, AML, sanctions. And we can, in these three domains, we can move upside down, you can go, you can pitch, because they are already interconnected. How we have seen from the client onboarding, once the client got onboarded, then he will be into, he can use the bank account, then we can perform sanction screening, then we can perform transaction monitoring. So it was like interconnected, so I can go along with these three types of process. Okay, that's all for now. If you do have any comments on this, you can just drop down in the comment section. And if you're watching this video for the first time, hit a like button, and it will help me to reach more audience. Thank you so much.